How much do I need to save to retire at 65? Or said another way, how much in retirement savings do I need if I want to retire at 65? That's what we're going to look at today on the Your Financial EKG YouTube channel. And let's talk about why we're talking about retiring at 65. What happens when you turn 65? You go on Medicare. Medicare is your health insurance when you turn 65. Now, the average retirement age in America today is 64 years old. That is the average retirement age that most individuals start claiming Social Security benefits after they retire. And why do you think 64 is the magical number? Well, you've got 1 year until you turn 65. And what happens? You go on Medicare, and what cost automatically comes down when you're on Medicare? Your health insurance. Boom, it comes down. Why does your retirement health care cost come down when you turn 65? Because you move off of private insurance and you move on to Medicare, or the government's retirement insurance. So your cost might be $1,000 a month for health insurance before 65, but as soon as you turn 65, your Medicare insurance premiums outside of what comes out of your Social Security check may be $0, maybe $150, maybe $200 a month, but that's a far cry from what private insurance costs. Another reason why many individuals retire at 65 is because they're 2 years away from full retirement benefits with Social Security. Now, you can claim Social Security at 62. That's the earliest date that you can claim Social Security benefits. If you do that, you'll get 70% of your full retirement benefit. If you wait until 67 to claim Social Security benefits, you're going to get 100% of your promised full retirement benefit. Or if you wait till 70 to claim Social Security benefits, you're going to get 124% of your full retirement benefit. Now, if you retire at 65, you're only 2 years away from your full retirement benefit, which means one of two things. Either you start taking Social Security benefits at 65, so you get more than the 70%, but not 100% of your full retirement benefit, which you would have gotten at 67, or you wait 2 years to claim Social Security benefits at 67, claim 100% of your full retirement benefit, and for the 2 years that you're retired between ages 65 and 67, you use your retirement investments for your retirement income. So that way that your running room or your landing pad or whatever you want to call it is not as long for taking out retirement income before you start taking Social Security. Now let's talk about what you need to consider if you're wanting to retire at 65. Now, the first thing you want to think about is how much will your Social Security payment be when you turn 65? That's going to be key in understanding if you can retire at 65 or earlier or later. What is your Social Security payment going to be when you retire at 65? The second factor you want to consider if you're thinking about retiring at 65 is, what will my retirement expenses be? Meaning, how much in retirement income are you going to need to cover your baseline expenses? Your baseline expenses in retirement, that's your utilities, that's your lights, your food bill, your property taxes, any insurances that you may have, things that are not going to change, expenses that are going to go on in perpetuity. Those are called fixed expenses. Now, you're also going to have variable expenses in retirement. Variable expenses might be, hey, I'm going to retire at 65 and I want to travel from 65 to 75 years old. That's a variable expense because I live in Tampa, and if I fly to Paris, France, it's going to be a lot more expensive than if I fly to Paris, Texas, right? Variable expenses. My trips vary in cost, right? And so your variable expenses in retirement need to be understood as well as your fixed expenses in retirement. And something that a lot of people overlook when they think about their expenses and their retirement income is your personal inflation rate. Your personal inflation rate is the inflation rate on your retirement expenses and how your retirement income can cover that inflation rate. Let me give an example. Let's say you have a fixed mortgage payment. It's $1,000 a month. Your interest rate for that mortgage payment is 5%. That interest payment, that interest rate is not changing between now and the end of your loan term, whatever that might be. That's a fixed payment and the inflation rate is 0. Now, let's say you have a grocery bill of $200 a month, or like my family with 3 kids, 2 dogs, and a wife, $500 every time we walk into Costco because raspberries are so expensive. Let's say that inflation's running at 5%, food inflation. Now you have a variable cost that goes up and down based on what you purchase, and the inflation on those goods can go up and down based on the inflation in the economy. So you have 2 types of expenses that you need to really understand when you get into retirement. That's why when we run our Financial EKG, our comprehensive retirement plan for clients, we're looking at these little things because inflation is huge. You have to understand the money that you're spending today is going to be worth less than money in the future. And so how do you calculate that into your retirement income plan? And the last thing you want to think about when you're thinking of retiring at 65 is how much retirement income are you going to need over and above your Social Security payments or any pensions and annuities. So let's say your Social Security is $2,000 a month, but your expenses are $4,000 a month. That means you need $2,000 a month in retirement income from some source. That's $24,000 a year this year. Next year, add inflation onto that, and it might be $25,000 a month. Now, you do get a cost of living adjustment with Social Security, and some pensions and annuities offer that as well. So you really have to be thinking about how much overage do I need? And the question is, can I retire at 65, and will my retirement income last throughout my retirement? And when you factor those 3 factors in, you get yourself a really good answer, and that's what we do with the Financial EKG. Now, let's get into the software. Let's determine at 65 how much in retirement income you need, how much in retirement assets you need. Let's look at inflation. Let's look at taxes. Let's put this all together so you can have an actionable financial plan that you can put into place today. All right, we're going to look at, can I retire at 65 with $575,000 saved for retirement? We're asking the question, how much do I need saved for retirement to retire at 65? I want to look at Donald. He's got $575,000 saved for retirement. We're going to go through a full EKG, a financial EKG, we call our comprehensive retirement plan. I want you to see how we do this for Donald, and then you can take that data, put it to your financial plan to see if that's going on in your life. Now listen, if you want a financial EKG, go to the link below, sign up on our website, get on our calendar. Let's go through your financial plan to get you to retirement, through retirement, and protect your ability to stay in retirement. So here we go. I've got Donald Duck. Okay. Now, obviously, we changed his last name. His first name is Donald. Donald lives in the great state of Arkansas. Sweet pig. I think that's what y'all do. I'm from Kentucky, so I don't know anything about that. But Donald is a warehouse manager, as you can see here, and he has a gross annual salary of $80,000 a year. Now, he's 60 years old. Okay. He's 60. He wants to retire at 65. So we have a 5-year running room to ask ourselves, can I retire at 65? Now, the reason that Donald wants to retire at 65 is because he has great health insurance, and Donald has some health issues. And if he were to retire at 60, he would have to get health insurance on the exchange. And he's not confident that he can get quality health insurance, the same quality that he has now, on the exchange. So because he has health issues, he's going to continue to work till 65. He has chronic things that need to be cared for on a quarterly basis. And so he's going to continue working until 65 when he can get on Medicare and lower the cost. You may be the same. And that's why we're looking at this exact scenario. Now, Donald has Social Security benefits of $2,915. That's at 67. Now, keep in mind, If he retires at 65 and he wants to take Social Security immediately, that would be $2,526. Now, at 62, which we're not going to claim because he's working, would be $2,040. That's 70% of his full retirement benefit. Now, if you're working and you claim Social Security, you're only allowed to earn a certain amount over a threshold. If you go over that threshold, the IRS says, give us back $1 for every $2 you make. It's about $20,000 is a threshold. It goes up every year with CPI. So all those videos that say, hey, keep working, claim your Social Security, invest it, it's going to be so much better. That's wrong. That is bad advice. Now, if you're retired or if you're working part-time and you make less than $20,000, then maybe it would work for you. But full-time working, claiming Social Security before your full retirement age, don't do it. Okay? Now, we're going to look at taking Social Security at 67. We got 2 years to make up the income that we need based on his expenses, but we can always go back to 65 if we need to. Now, from an asset standpoint, he's basically got two investments. He's got money in the bank of $10,000, and he's got money at Merrill Lynch of $405,000. That's his 401k. It's through Merrill Lynch. He's doing a contribution of $1,000 a month. So his 401k contribution is $1,000 or $12,000 a year. Now, his company gives a match of $200 a month. So there's $1,200 going into his 401k every month. And he just has the two investments. He's very simple. He's been working at the same company as a warehouse. Well, he's a warehouse manager now, but he's been working at the same company for some 30 plus years. And so he's happy where he's at, and that's why we have the two investments. Now, Donald does have a home. It's worth $325,000. So from a net worth standpoint, we've got $415,000 in current spendable assets. We have $325,000 in protected assets. That means like your house, or if you had gold or silver or antique cars or whatever, that would be a protected asset, something that is not easily turned into liquid investments fast, right? Spendable assets are things that can be cashed in or used as cash very quickly. Non-liquid assets are like your house, cars. Maybe you have, like I have, signed baseballs, things like that. Things that are harder to turn to cash quickly. Now, from a rate of return standpoint, so his $405,000 that's at Merrill Lynch, we have to give it a projected rate of return. Now, the stock market's averaged about 10% since 1950. It's 8% with inflation. We're going to give it a 5% rate of return just to be really conservative. Now, I know there's people out there that comment all the time on this channel that say, oh my gosh, you can get so much more than that. Or they say, oh my gosh, that's way too high. Listen, I just use 5%. It's a nice round number. It's conservative. If you don't like it, put in whatever you want. Now, after retirement, we're going to do 4%. So we're going to be at 5% before retirement. We're going to be 4% after retirement. So we're going to downshift, right? We're going to downshift our retirement risk as we go into retirement. That's something that a lot of people don't think about. They don't talk about. When you're investing going to retirement, it's a totally different thing to invest after retirement, right? Before retirement, you're doing capital growth. You're trying to grow your assets. You're putting money into your accounts. You're getting a paycheck every 2 weeks. Once you get off the working train and you get into retirement, it becomes more about capital preservation and paying out income. It's what we call the distribution phase. And your investments shouldn't be the same, because the roller coaster that you're on when you're working and you're adding money to your 401k, I call that Space Mountain. If you've ever been to Disney World, it's a roller coaster. It's in the dark. It goes up and down and spins you around. And because it's in the dark, it feels really fast. You know you're going to get off. You just don't know when, where, and how. When you get into retirement, you don't want to be on Space Mountain. You don't want to have to guess, what's the market going to do? Do I have to wake up and look at Jim Cramer today? No, you want to be on the Walt Disney World Railroad. You want to be consistent. Boom, boom, boom. I know where I'm getting off. I know I'm getting off in Tomorrowland. I know I'm getting off in Frontierland. I know, it's consistence. So that's why we're going to go 4% on our rate of return at retirement. So going into retirement, we're at 4.93% rate of return. It's a little bit less than that once we get into retirement. Now, from an expense standpoint, we're going to break this down. We have a mortgage payment, principal and interest, of $1,200. Now, here's what we talked about earlier, inflation. So the mortgage payment has a $1,200 payment, but 0% inflation, right? That $1,200 has been the same payment for the last 20 plus years. It's ending in 128. So we know this $1,200 is going to go away in 5 years. Now, for Don, what happens in 5 years? Oh, he's retiring. He's going on Medicare. So he's timing his retirement with losing a big fixed payment or fixed expense. And that's something you need to think about. If you've got a mortgage, can you retire when that mortgage goes away? Can you eliminate that mortgage? Because housing costs and healthcare are the 2 top costs in retirement. And that's expensive. So he's going to lose this mortgage payment when we get into retirement. And I'll show you how all that works. He has baseline expenses of $3,000. We have inflation on that, 3.27%. That's the 109-year average. And travel of $500 a month. He wants to have travel for 10 years from 65 to 75 of $6,000 a year with inflation. Now, Donald's not much of a overseas traveler. He's more of a domestic guy. He's from Arkansas. He's a football fan. I'm sorry, but he wants to go around and watch Arkansas play football in the SEC. So that's kind of what he wants to do in retirement. So that's okay. He can do that. He can do whatever he wants. I want to go see all the ballparks, right? I've seen Tampa and Cincinnati and Atlanta and Chicago. There's a lot out there that I want to see. I've been to New York, both of them. I want to go to see a lot more. I need to go to the West Coast. If you've got some good ballparks that you want that I should go visit, put it down below. Professional, minor league, tell me. I want to go see them all. All right. So that's our expenses. Now, so we have $4,200 expenses, but see the inflation rate, 2.34%. That's because not all of this has inflation. That's why it's really important for you to understand what your personal inflation rate is. Now, from a tax standpoint, let's go to the year 2024. So taxes aren't that big of a deal. He's got a projected federal tax rate of 10.65%. Everything he's got is pre-tax. So everything is before taxes. So when he starts pulling money out of his 401k, it's going to be ordinary income on that. So right now, we're not as concerned about that. His projected state tax, or 4.63 is the highest state tax. He's going to finish somewhere below that. So we've got wages of about $80,000. Here's our qualified contributions of $12,000. Gross income is $68,192. There's our deductions. Taxable income, $54,342. Here's our bases. So we basically have a 10.65% federal tax rate. Now, he's in the 22% bracket. You see that 22% bracket? Everybody likes to talk about brackets, but no one really likes to talk about effective tax rates. It's always like, tax the rich, tax the rich. Listen, you can tax them all you want, but their effective tax rate is going to be a lot lower than these high rates right down here because we have a progressive tax code, right? The first part of your income is taxed at 10%, 12%, 22%. We have credits, deductions, things like that. And so for him, taxes aren't that big of a deal. Now, one of the things that we can talk about with Don is Roth conversions. Now, all of his money's in 401k. Some 401ks allow you to do Roth conversions while you're inside your 401k. We could also roll money out of his 401k because he's over the age of 59 and a half. Some 401ks allow you to move money out of your 401k. We could start doing Roth conversions on that. The thing we have to be careful of is in a couple years, Don's going to run into what we call Irma taxes. Irma taxes are when you're on Medicare. It's the cost of your Medicare. If you earn a certain amount of income, Social Security will charge you more for your Medicare premium. A lot of people don't talk about that when they talk about Roth conversions. They just say, hey, do these Roth conversions. It's not just earned income, it's also Roth conversions. It's all your income. I've had clients sell apartment complexes, and that's not their main source of income. I mean, they're just on Social Security, and Medicare comes back and says, hey, your Medicare premium next year is going to be $450. And they're like, well, my income didn't change. They're like, well, you had a $700,000 capital gain. And he's like, well, I just sold an apartment complex. That doesn't happen every year. They don't care. So we have to be really careful when we're talking about Irma taxes and Roth conversions and things like that. And that's something we could look at down the road for Mr. Duck, right? Donald Duck. All right, so pre-retirement, here's where we're going to look to get to that 575 figure, which we talked about at the very beginning. So Don's current gross monthly salary is $6,666. We've got monthly contribution of $1,200. That means his net monthly income is $4,246 net, meaning taxes have come out, right? We've got our net monthly expenses of $4,244. We have a little bit of a cash flow positive there. So we go from $415 to $574,116 at 64 years old. Now we go to retirement, and you guys can see here. So we've got 2 years where we're not taking Social Security. We're going to wait till 67. 2915 is 100% of his full retirement benefit. So that means this $4,055, this is net monthly expenses with inflation, is going to have to come out of his investments, right? It's going to have to come out of this figure right over here, this 551,805, which is earning right about 4%, right? We're talking about 4% rate of return. So what you can see is we take 2 years of income out of our retirement investments, and at age 67, we start kicking on Social Security. Now let's stop right there for a minute. Something you can think about, when we're in this 2-year gap, what if the market stinks? What if the market just falls on its face? Sequence of return risk. Sequence of return risk is that Don goes into retirement and the market falls immediately. Think the year 2000 when the market fell, boop, 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 2001, 2002, or 2007, 7, 8, 9, boom, market was falling. So you go into retirement and the market goes down. What do? Well, in Don's case, he takes Social Security. Why wait? Don't take money out of your retirement investments. Don't work longer. Take Social Security. We're doing a projection. We've got 5 years before we get to retirement. We got 7 years for Social Security. What can happen in the next 5 to 7 years? I don't know. Lots of stuff, right? I had a crystal ball. I dropped it on the way to the office. So we need to look at this for Don and be flexible enough to say, hey, what if we take Social Security at 65 if the market stinks? And those are scenarios that we need to look at. So Social Security is going to kick on at 67. You can see how his expenses continue to go up with inflation. Now at 75, you see where it went from $5,417 at 74, and at 75 it went down to $4,900. You may be thinking, what happened, Drew? Why did the expenses go down right there? He stopped traveling, right? Remember that travel expense we had for him to go to all the college football stadiums? That went away at 75. He said, at 75, I'm not going to be able to do this. Now, he could continue this on. We've got $490,000 in spendable assets projected at that place. Once we get there, it might be more if the market does better. So that's something that he could continue to do that if his health allows him. Remember, Don's got a little bit of a chronic health issue, which is why we're retiring at 65. So there's a lot of balls that are being juggled right now, that the reason that Don came to me is because we're going to have an ongoing relationship. We're going to have quarterly reviews. We're going to make sure this plan gets him to retirement, through retirement, and protects his ability to stay in retirement, because we don't want Don to get to 74 and go, what am I going to do? All right. So we come all the way down here, and at 97, Don's out of money. Now, we still have the house. It's worth $472,000 at that point. We just gave it a 1% rate of return. Obviously, somewhere in the 80s, we could do a reverse mortgage, which they call a home equity conversion mortgage. We could do a lot of different things. This is a really good plan. Here's what I want to show you. Let's go back. What if we did Social Security a little early? What if we started Social Security 2 years early? Remember we were just talking about that? So our software actually says it's more optimal for Don to take it at 70. You see that? It's got him an extra year's worth of income. That's based on the 4% rate of return. So I know from the software, taking it at 70 is most optimal for Don. And the reason for that is he's single. We're trying to maximize that Social Security payment. That's going to be the best for him going forward. Now, that might not be what everybody wants to do, but I'm just telling you what the software says. If we back up to 65, the software backs him up to 96. He actually runs out of money a year earlier. But again, remember what I talked about. If the market's going down, it's going to make a lot more sense to take Social Security. The software can't calculate the future. It does not know what's going to happen in the future. It's just saying based on these projections. So that's something that we always want to look at and say, what's going to make the most sense for you, for your individualized plan, right? Because there's a lot of things that go on. Don has a chronic health condition. One of his big concerns is long-term care. So let's look at that. What if long-term care happens? Well, this is Arkansas. And we're going to assume that Don needs long-term care at 80. Okay, so he's in Arkansas. You can see that here. So the current cost, right down here, based on the 2021 survey, the current cost for in-home care, right, $4,185. For an assisted living facility, $3,760, and for a nursing home, $6,000 or $6,600, depending on what kind of room you've got. Most people today are in home health services, right? They stay at home. So Don's single, so let's just say he wants to stay at home. So what we can do is we can say, okay, Don, at 80, you're going to need home health care. The current cost for that home health care is $4,195. That's for a home health aide. We're going to give it a cost increase of 3.07. That means your current daily cost is $140 in today's dollars. So we go to 80, that means the future cost is $7,805 a month. You see that? $4,100 to $7,805. Future daily cost has gone up. So his projected lifetime expense is $387, okay? So we come down here, and essentially at 82, if we're in care for 4 years, he runs out of spendable assets. Now we still have the house that we can do a reverse mortgage. We can sell it, move into a facility at that point. So from a long-term care standpoint, he's put himself in a good place. Now, again, if it's Alzheimer's, dementia, and he goes 10, 15, 20 years, there's only so much that you can do. But if it's a normal situation, which, I can't predict outliers, but if it's a normal situation from a long-term care standpoint, he's going to be okay. All right. So can Don retire at 65 with $575,000? Yes, he can. How much does he need in retirement assets in order to retire at 65? Somewhere between $500,000 and $600,000 in Arkansas will help him to retire. All right. I hope this has helped you in your financial planning. Thank you so much for watching. God bless. Bye-bye.